As the markets are currently closed for the weekend, Opendoor Technologies Inc., trading under the ticker OPN, concluded its most recent session on Friday, October 3, 2025, at a price of $8.11. This represented a modest gain of 1.25% for the day, a flicker of green in what has been an extraordinarily volatile period for the stock. But to fixate on that single day's movement is to miss the tectonic shifts happening just beneath the surface. The expectation is that Opendoor is a simple, high-beta proxy for the U.S. housing market, a blunt instrument entirely at the mercy of mortgage rates and macroeconomic winds. The reality, however, is a far more complex and fascinating battle being waged on multiple fronts: operational efficiency, technological leverage, and a desperate fight for market share against a deeply entrenched legacy industry. The hidden narrative isn't just about the direction of housing prices. It's about whether a disruptive model can survive a cyclical downturn long enough to dominate the recovery. The common belief that has shadowed Opendoor, particularly among retail investors using platforms from the Robinhood app to SoFi Invest, is that the company's fate is inextricably tied to the Federal Reserve's policy decisions. When rates rise, the model breaks. When rates fall, the stock flies. This is, on the surface, a logical assumption, yet it dangerously oversimplifies the reality of the situation. Deeper analysis reveals that while the macro environment is a powerful headwind, the company's internal metrics, its contribution margin per home, its holding times, and its expense management are the true determinants of its long-term viability. The market often prices Opendoor as if it has zero control over its destiny, reacting violently to every inflation report and Fed statement. But recent trading activity tells a more nuanced story. Over the past month, we've witnessed days of staggering volume, sometimes exceeding 200 million shares, completely disconnected from any major housing news. This isn't just macro-driven panic selling or euphoric buying. It's a sign of a fierce debate playing out in the market between long-term believers in the eye-buying disruption and tactical traders betting against its capital-intensive model in a tight credit environment. Institutional players, from major asset managers whose trades are executed through platforms like Interactive Brokers to smaller, more agile hedge funds, are building and trimming positions with a velocity that suggests a deep uncertainty about the next 6 to 12 months. This level of churn is less common in stocks with a simple, universally agreed-upon narrative, unlike the more predictable patterns seen in giants like Apple stock or even the sentiment-driven swings of Tesla stock. Let's dissect the recent stock movement with greater precision. The past quarter has been a microcosm of this tension. After hitting a 52-week low near 50 cents earlier in the year, the stock staged a monumental rally, surging over 1,000% to touch highs above $10. This was not a slow, steady climb. It was a series of explosive, high-volume spikes, often triggered by short squeezes and a surge in options market activity. The implied volatility on open options has remained extraordinarily high, indicating that the market is pricing in the potential for massive price swings in either direction. Following the latest earnings report, where the company beat revenue expectations but offered cautious guidance, the stock saw a sharp pullback. Traders on various Fidelity trading platforms and other online investing sites reacted to the guidance, confirming the market's sensitivity. Yet, it found support at a key technical level, refusing to break down completely. This resilience, in the face of a hawkish Fed narrative and persistent affordability challenges in the housing market, is the piece of the puzzle that the simple interest rate proxy argument fails to explain. It suggests that a significant portion of the market is looking beyond the immediate cycle, focusing on the potential for Opendoor to emerge from this downturn as a leaner, more efficient operator. This is where the real due diligence for anyone considering self-investing begins, looking past the headlines and into the operational core. To understand this dynamic, one must understand what Opendoor actually does. The company is a pioneer of the eye-buying, instant buying model. In essence, it uses vast amounts of data and proprietary algorithms to make near-instant cash offers on homes. The value proposition for a seller is speed, certainty, and the convenience of avoiding the traditional, often cumbersome process of listing a home, staging it, and navigating months of uncertainty. Opendoor then performs light renovations and aims to resell the home on the open market for a profit, generating revenue from the service fee it charges sellers and the spread between its purchase price and the eventual sale price. It's a business built on thin margins and high volume. In a booming housing market with rapidly appreciating prices, this model thrives. In a flat or declining market, holding inventory becomes a significant risk. As each day a home sits on the balance sheet, it accrues holding costs and is exposed to potential price drops. This is the fundamental risk that has many investors, whether they are using sophisticated analysis tools from interactive brokers or making their first investment help queries online, so cautious. The company has been forced to aggressively mark down its inventory and refine its pricing algorithms to survive the sharp turn in the market over the past couple of years. Looking ahead, the future of Opendoor hinges on a delicate balance of external and internal factors. The most significant external catalyst remains the path of mortgage rates and the overall health of the residential real estate market. A scenario where inflation cools sufficiently for the Federal Reserve to begin easing monetary policy would be a powerful tailwind, improving housing affordability and likely increasing transaction volumes across the board. However, the risk of a higher-for-longer interest rate environment or even a stagflationary scenario remains the primary threat. This could keep the housing market locked in a low-volume state, severely constraining Opendoor's ability to scale and achieve profitability. The company's future is less about a broad market recovery and more about its ability to execute within whatever market it finds itself in. Can its new AI initiatives truly enhance its pricing engine to a point where it can consistently acquire homes at the right price, even in a volatile market? Can it continue to reduce its operational expenses and holding costs to improve its unit economics? These are the questions that will define the next chapter for Opendoor, far more than the simple question of whether housing prices will go up or down. For investors managing their own portfolios, perhaps through a Schwab Intelligent Portfolios account or a Fidelity brokerage account, understanding this distinction is critical. Investing in Opendoor isn't just an investment in housing. It's a venture-style bet on a specific technological business model. Do you believe the government will pass legislation in favor of the housing industry anytime soon to alleviate affordability issues? Comment below with your thoughts. The bull case rests on the idea of market share consolidation. As smaller competitors and traditional players struggle in a challenging market, a well-capitalized Opendoor could capture a larger piece of the pie. If it can prove its model is resilient through the cycle, it could emerge with a dominant position when the market eventually turns. The bear case, conversely, points to the immense cash burn and the inherent difficulty of accurately predicting local housing market microtrends. Critics argue that the iBuying model is fundamentally flawed, unable to withstand the cyclical nature of real estate without taking on unacceptable levels of risk. This isn't a stock like Nvidia stock, which rides a clear secular trend in artificial intelligence. Opendoor is in a cyclical industry, trying to forge a new, counter-cyclical path through technology. The path to sustained profitability is narrow and fraught with macroeconomic peril. Success will require near-flawless execution and a bit of luck from the broader economy. In summary, the narrative surrounding Opendoor Technologies is a classic case of expectation versus reality. The market's expectation is that of a simple real estate proxy, a leveraged bet on falling interest rates. The reality is that of a technology company engaged in a high-stakes operational battle to disrupt one of the world's largest and most entrenched industries. The recent incredibly high-volume trading and extreme volatility reflect the deep division among investors about the company's prospects. While the macroeconomic environment will undoubtedly shape its short-term fortunes, the ultimate success or failure of this stock will be determined by its internal ability to manage risk, refine its technology, and achieve the operational efficiency necessary to make the iBuying model not just viable, but dominant. The question for any investor looking at Opendoor is not just where the housing market is going, but whether they believe this company possesses the unique operational and technological edge to fundamentally reshape it. That is the core of the investment thesis, and it's a reality far more complex and compelling.